Last week, I believe the headline for this video was the correction is on. I think you said, hey, the correction's here. It's just a matter of how far down we go. Here we are a week later. S&P had a massive jump this week, right? We went from like 5,400. I think we're above 5,600 now that we're talking here. So correction brief over. Yep.
At least for now.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart, welcoming you back here at the end of the week for yet another weekly market recap featuring my good and mercurial friend, Lance Roberts. Lance, how you doing?
Good. How are you today, Adam?
I'm doing well. You're actually really giving off a big mellow vibe here, Lance, but I picked mercurial because markets have been quite volatile of late. And that was a big theme in the interview that I did earlier this week with Jim Carson, better known as Jam Croissant on Twitter. Maybe we'll get into that a bit because he sees volatility rising through the end of the year, though higher volatility in his definition does not necessarily mean lower prices. But anyways, in the short term, he seems to be validated here.
Yeah, no. And look, I mean, we just added some VIX calls to our platinum model, which runs options, just on expectation that between now and the election, there's still that potential risk for, with polls very tight right now between Kamala Harris and President Trump. There's a real risk of not really knowing who's going to win the election. So between now and the election, there's a risk that we could see increased volatility through choppy trading, right? So we just see markets sell off a bit and they rally up. But right now, the markets are doing great. Over this past week, we had the secondary correction. Now we're rallying back up near all-time highs. And we're just triggering a MACD buy signal today on Friday. So, actually the bullish backdrop to the market's very good, but it still doesn't mean you can't have some choppy trading between now and then. And so we're adding a little bit of hedge, kind of just hedging some risk going into the election.
Okay. And that's consistent with what you've been saying for months now, that you expect things to get more volatile as the election approaches. A couple things.
But real quick, that's a maybe. We're just looking at statistical, kind of historical statistical, averages. And it suggests that between the 15th of September and October the 15th, markets tend to come under pressure a bit as markets de-risk. However, we've already kind of de-risked a bunch. We had the sell-off in late July, early August. We rallied back from that. We had another correction, about 4%, last week. We've rallied back from that now. So, we've done a lot of that work. We've worked off a lot of that overbought condition that existed. So there's no guarantee that this market sells off anymore. I mean, we could rally right into the election from here. Our earnings go well. We get stock buybacks come back at the end of October, which we don't have right now, by the way. And then once buybacks come in, you get a strong November, December. So, there's no guarantees here. And that's why we just do a little bit of risk management. We're hedging for volatility risk just in case. But we're not, eliminating a bunch of long exposure because markets are doing fine right now.
Well, and that's what I want to underscore about the Jim Carson discussion, which, folks, if you haven't watched it, is fascinating. Jim looks through the world through the volatility lens, and I'll say it's a different view than most of the folks that I interview on this channel, but it makes a lot of sense when you hear him explain it. And his model has a lot of explanatory power for a lot of the patterns that we tend to see. So why does September tend to be the most volatile month? There's actually a lot of reasons that go into that. Some are macro, some are calendar driven, just forced like rebalancing and things that have to happen. And some are actually based on human nature, where low volatility basically breeds high volatility. Or if you get volatility compressed for long enough, it's like a coiled spring, it'll eventually release. And the fact that people take their vacations in the summer actually is a contributing factor to it. Not the only factor, but it's really kind of fascinating, again, once you sort of see through his eyes. But just again, to underscore, because it's consistent with what you were saying, Lance, he's saying like higher volatility does not necessarily mean lower prices. And he expects volatility to increase as we go into the end of the year here, and actually maybe even end the year kind of on a volatility high. But he also expects, all things being equal, no changes in the forecast between now and then, that prices will rise and potentially even kind of have a bit of a runoff at the end of the year. He then thinks volatility will remain high going into the new year, but we may have a turn where all of a sudden higher volatility starts bringing in lower prices for a bunch of the reasons that you and I talk about, on this channel week after week. So anyways, there's not too many inconsistencies between you and Jem, it sounds like, but you're both planning for more volatility, or at least you're protecting against it, we'll say.
Yeah. Look, and there's, that's the thing about markets, is that there's no guarantee of anything. And this is why it's always, the biggest challenge that investors have, and the thing that impairs their ability to make money in markets over time, is they bet on certain outcomes. They go, oh yeah, well, historically this has always happened, so I'm going to be out of the market, or I'm going to be all in the market for whatever reason. And, and then things don't work that way, because again, you have to be very careful with a lot of this data. For instance, September, October, yes, those tend to be the weakest trading months of the year, on average. And see, there's the big
There's
word,
the rub, average, yeah.
because those 2 months happen to also include the crash in 1987, the crash in 1929, the crash in 2008. So all those big macro declines occurred in September and October. And so those are skewing those averages a bit. Now, it's also important to realize that most bear market bottoms form in October, because that's generally where market, like for instance, the crash of 87, markets crashed in the first part of October, bottomed, and then started rallying and going into November. So again, averages are one thing. Another good example of this is the sell in May, go away. That's a great way to look at your portfolio over time, because historically returns are lower in the months of May through August, and really September, because of, again, all these kind of seasonal historical things. If you only invested in the summer months, your return is essentially about 1% historically. If you only invest from October to May, your returns are about 12 to 13%. S&P returns, right? So the bulk of the returns of the market happen to come in the seasonally strong period of the year. But does that work every year? Absolutely not. Last year was a good example that it didn't work. You had a terrible summer. Markets were down 10%. The year before that, it was great. So,
right.
You got to be really careful with averages and really focus on, what is the market doing right now? What's it telling you technically here in the short term? Because that's what drives returns. It's okay to have these bigger, again, we look at statistical averages, and I'm not saying that we don't, because we do. The reason we're buying some volatility hedges right now is because of that statistical norm. And he's absolutely right about, seasonal vacations. A lot of traders are gone. Europe is closed for the most part in terms of the major banks. So there's less trading activity in the markets. Kind of the inmates run the asylum, so to speak. So we tend to have higher volatility. So we've had this recent little spike in volatility in August. It's come down. We've got rising bottoms in the VIX right now, and suggests that VIX volatility wants to try to trend higher. As you said earlier, low volatility begets high volatility, and vice versa. And then we'll take it from there. Once we kind of get through this election, we can kind of pull the guardrails off a little bit, and kind of see how the market runs into the end of the year.
Okay, so this is a good segue into my next question, which is last week. I believe the headline for this video was the correction is on. I think you said, hey, the correction's here. It's just a matter of how far down we go. Here we are a week later. S&P had a massive jump this week, right? We went from like 5,400. I think we're above 5,600 now that we're talking here. So correction brief over. Yep.
At least for now. So, again, so this is just the S&P. And again, as we were talking last week, markets were sitting. And remember, so let's back up to last week for a second, because last week we recorded on Thursday. We didn't record on Friday like usual. And so when we were talking last Thursday, I made the comment that, hey, this correction is in process. We've been correcting. We were sitting right on the 50-day moving average. And we were kind of at that make or break point. If the market could hold onto the 50-day moving average and then rally back up, that was great. On Friday, completely fell apart. We had the big sell-off on Friday. We came down to test the 100-day moving average, and then the market bottomed there. So unfortunately, you and I weren't talking, or we would have had probably a little slightly different conversation at that point. But the market held on to support there. And then again, it rallied all this week. So we've now rallied back up above. Very interesting too. We actually had a very bullish week technically. The markets rallied back to the 50-day moving average. And then on Monday and Tuesday, on Wednesday, that was the inflation report. And immediately coming out of the gate, when core inflation came a little bit hotter than expected, the market sold off and retested the 100-day moving average for about a second. Then about 10 o'clock in the morning, Goldman Sachs is having their tech conference. I believe it's in New York. And the CEO of NVIDIA came out and said, there's so much demand for our chips, we just can't simply keep up. And the market reversed right on that comment, not only rallied back to the 100-day moving average, completely recovering that sell-off in the morning on CPI, but then rallied to the 20-day, which had already crossed above the 50. So we had a bullish cross of the 20 above the 50. So again, that's telling you markets are kind of trending higher, prices are moving higher overall. But when we recovered back above that 50, you had a double test of that 100-day moving average. So you had a very good retest of support, and then you had a breakout of that previous failed resistance at the 50-day. So that right there ended the correction. And then, of course, over the next couple of days, we've now rallied above the 20, and now we're challenging the previous high going back into July. We're still below the all-time high. So again, we're not too far away. We do have some more resistance here. So again, we've kind of come pretty far, pretty fast, which is fine. Markets are about to trigger a buy signal, but I kind of expect maybe a little bit of a failure somewhere in there. Markets pull back a bit, maybe back towards this 20-day moving average, reestablish that 20-day moving average of support like it was all previous year in May, June, and July of this year, kind of reestablish that support at the 20-day, and then markets try to work their way higher over the next week or so.
Okay. Let me just ask, let's say we run into resistance here and the market sells off a little bit in the next week or two. Yep. Is there any concern about we've heard of the term triple top? Like, would that make a triple top here or not?
Well, in order sure. I mean, like right now we have a double top, technically. We had a lower high. I actually kind of wrote about this earlier this week. I wrote a report on at realinvestmentadvice.com on Tuesday, talking about 3 bullish takes and 3 bearish takes for the markets from a technical base. And from the bearish equation of that, yeah, you've got a double top in, you've got lower highs, and what you need to establish is lower lows. And right now we don't have that. So right now we've got a compression, as you can see, these 2 orange lines. You've got this compression of prices. So this is kind of forming a wedge at this point. So if we break out to the upside of this wedge, that compression, it's like a spring, right? You compress prices, and then once you break out, they're going to take off running in one direction or the other. If the market fails at this downtrend line and at this previous resistance, comes down, takes out this rising bottom, then yeah, you've got some concern here, and you're going to have a move lower. You initially will retest the 100, then you've got the 200-day below that, which is in line with the August bottom. So there's still risk to the downside. I don't want to say there's not any risk, because there certainly is. And if we start getting a sell-off in the markets because of concern over the election, or one thing Mike and I are watching very closely right now is the Japanese yen, which is up strongly again this morning. That was the trigger for that yen carry trade blow off back in August. So, there's certainly some risk out there, and you can't, completely ignore those risks. But right now, the backdrop is more bullish than it is bearish. But we still need to be concerned about this technical formation until it confirms and resolves itself.
Okay, and we're talking about what ifs here, so nobody knows. We'll watch the action. We're going to let you update us on a week-over-week basis here. But right now, the action is bullish, right, Lance?
Yeah, for now, for today, right? Today it's bullish.
Okay.
Market sells off. This is the thing about markets, right? I mean, talk about volatility. You take a look at that chart. I mean, it was all-time high, and then we dropped down 8.5% in a correction. Then you rally it all the way back. Then you sell off another 4%. That's volatility, right? And market hasn't gone anywhere. That's a nice consolidation. Markets haven't really gone anywhere. but it's certainly been a wild ride. And, you've gone from, euphoria to despair to euphoria, back to despair and back to euphoria again. So, that's how markets whip investors around. And this is what gets investors to make bad decisions. The panic selling in August. Oh, it's a yen carry trade. I got to get out, and then the market rallies right back. And it's like, oh, damn, now I got to get back in. So they buy right at the peak and then it rolls over and sells off again. It's like, damn, I got to get out. And then now it's back up to where it was. It's like, and this is why investors quit over time, is because of that emotional, kind of roller coaster that kind of works against investor psychology over time. And this is why it's really important to have some technical indicators, and take a look at, what you're doing in your portfolio, how much risk you have. And this is why we talk about risk rebalancing and, portfolio rebalancing so often. It kind of gets to ad nauseum. It's like, hey, rebalance risk, take cash. It's like people are like, yeah, you said that last week. This is why it helps protect you from this type of stuff.
So again, this is exactly why I chose mercurial as the adjective to kick off today's video with. And yeah, to your point, like, again, we don't know exactly what's going to happen in the future, but I think the reason why we're really hammering this is, this could continue for a good while here, right? And so this is, again, one of the many reasons why I have you and the other financial advisors on the program, so that people can see what a cool head and steady hand looks like when navigating periods like this. But also to your point that, yeah, we've talked many times about how people's emotions are really their worst enemy when it comes to investing at the individual level. And this is why many people should work with a financial advisor who is hopefully shielding you from your worst nature there on that. But as a capital steward, how do you handle these periods? How do you try to remain as unaffected as possible by the whipsawing?
Well, see, this is the difference between what you see on the video versus what happens behind the scenes. Because let me tell you, there's days where, like, I'm doubled over in agony. It's like, oh my God, what is going on here, right?
So you're like the duck. You look calm on the top of the water, but the legs are moving furiously.
Exactly. Look, I mean, everybody's human, right? And so, but look, I mean, there's definitely days where Mike and I. Okay, great example of this was Friday morning. Wednesday morning. I'm sorry, let me back up. Wednesday morning of this past week, we get the CPI report out. It's not terrible. It's right in line with expectations. Yeah, core was up a little bit, but food and apparel and other stuff was down. So again, just you have a lot of these kind of seasonal lags and anomalies and things. It's really, but overall inflation is still coming down and aligns with a whole lot of other things that we're looking at. So really, didn't change the Fed outlook any on rate cuts, didn't change anything about the trend of inflation. It's fine, but yet the market sells off 1.5%. So we're on the phone like, what the hell is going on here, right? And and so we're like, do we, what kind of, do we need to take some action or whatever it is? And then before we can even get through the conversation, the market completely rallies back up, on comments from NVIDIA. So and so, yeah, I don't want you to ever think that we're all just sitting back over here just going, oh, yeah, life's good. We just bought some stocks. It's great. We don't worry about it. Just, markets are fine over time. Trust me, there's some days I'm drinking some whiskey in the back, I'm done with it. But again, because we're all human, and the difference. And look, I'm not any better than anybody else, and I don't want you to think that I'm ever here saying, "Oh, I'm the best capital manager out there. I'm the best portfolio." I am not by any stretch of the imagination. I do my best, and I work very hard at it, and I hope I can deliver my clients, good returns over time, because that's my job. But I make mistakes just like everyone else, and but the thing that I have to do differently than somebody managing their own portfolio is I can't take just extraordinary risk. I can't go just buy SVOL or something like that and just say, I'm going to bet on volatility going up or down or whatever it is and take big bets. I just as a financial, just from a fiduciary standard, which we are fiduciaries, we can't do those type of things. We have to remain very cognizant of the risk tolerance that our clients have, and we try to manage within those boundaries. But again, just, we make mistakes just like everybody else. And, we're trying to navigate this just like you are. And, we're trying to evaluate this data for what it is that's coming in. The difference between when I say you, I'm using the ubiquitous you, not you, Adam, but everybody is the
It'll
you.
probably still apply, but you go ahead.
But the difference between you and me is that, you can take data and say, okay, this is what I think it means, and you can go take action in your portfolio based on that. I don't have that luxury because, again, we manage almost $2 billion now, and we have thousands of clients and families that are dependent on us growing that capital over time. And so our focus is analyzing data for what it is, and then applying that strategically and technically to portfolios to generate returns that align with a vast multitude of parameters that every one of our families need. So, because every family is different. I mean, some families are younger, they have much longer to grow capital. Some families are in retirement, they don't have that time. So we have to run all these different models, all these different structures to apply for all these different requirements that our clients have. And that's so our ability to extrapolate data for what it might be versus what it could be, we don't have that luxury. We have to analyze things for what they are and then manage for that.
Yeah, and I imagine too, it's you're like a pilot, right? Like let's say a fighter pilot to make it even cooler. But like, you you have incessantly sort of drilled and been trained and use, the full history of the learning in the field to make decisions under pressure, to be able to keep your blood pressure down lower than the average person when things are going crazy in the markets. And again, you tell me, but I mean, I think that's a big part of, again, working with a good seasoned veteran financial advisor is they've got the tools and they've got the trained mindset to be able to face risk in a way that is much less vulnerable to getting, wung around by emotions.
Yeah. Well, again, it's just kind of to my point earlier. It's Howard Marks made Howard Marks. If you don't know who Howard Marks is, he's one of the greatest kind of
living investors still. Yeah.
Living investors today. I mean, the guy's just a genius. He manages to stress debt and credit portfolios, but he's got just a tremendous amount of history and knowledge, and he's a very smart guy. And man, if you could ever get him for an interview, I'm all there for that one.
Working on it.
Yeah. But one thing he said one time is that, talk about managing money. He says, what separates a good investor from a not good investor is the ability to turn off the emotions. And you've almost got to be like Spock from Star Trek, right? Just have, just leave, kind of check your emotions at the door. And again, this kind of goes back. This is a challenge that, I have. It's a challenge that Mike's have, because I told you before that Mike and I are both inherently bearish, right? I mean, if just in isolation by ourselves, talking on the phone, we're bearish. And then, we're looking at the debt, we're looking at the economy, we're looking at all this other data, and we're like, this is not, great, right? The data that we have right now isn't great. And, then we have to look at each other and say, okay, that aside, set it over on the table. Now let's look at the portfolio and then manage the portfolio for what we have and manage for the data that we have and what the markets are doing. And so you've got, trying to separate out that emotion and be totally dispassionate about your portfolio is the hardest thing for investors to do. Here, these are some of the mistakes that everybody makes, me included, which is, I'm losing money in a stock and it's like, oh man, I don't want to sell it here. I don't want to lock in that loss, and maybe it'll come back. Terrible decision. If it's down, it's down for a reason. You got to analyze it. Is it simply just a technical issue, or is there a fundamental issue? We talked about our CVS trade. CVS farm, the store CVS, all the pharmaceutical health. We've tried that stock 2 or 3 times now. Finally, we've just given up on it. Fundamentally very cheap, but and technically it looks terrible. Right. But fundamentally, it's super cheap, pays a nice dividend, and just cannot get itself out of the dirt. And so we just had to step away from that, from the reality that there is something wrong with our thesis that we have not figured out yet. And until we can figure that out, we can't be in that position anymore. Doesn't matter how much we like it. Doesn't matter the fact that we lost money in it twice. That's just part of how it goes. But being able to sell your losers, cut your losers short, that's the most difficult thing that investors can do. The other side of that, the exact opposite of that, is selling your winners. Because when stocks are going up, you're like, oh, this is great. I'm just making all this money. I'm going to put more money into it. It just keeps going up. But learning to sell and take profits is also just as difficult, but it's one of the biggest mistakes that investors make. And that's why we regularly talk about, hey, we back in July, we trimmed NVIDIA and AMD and Microsoft and Google. We trimmed those positions back. They were all doing great. And at that time, like, why are you selling those? Well, because they're really overextended and we need to take some profits off the table because they're going to correct. And now we can look at those positions and say, okay, when do we want to start buying them again, right? NVIDIA has been improving a lot over the last week. It's technically turning up, being a lot more positive. So we may want to start adding back to that position soon. But that's, the inability to take those actions is that emotional bias weighing in on you, and how you keep talking yourself out of taking action that you should. And you've got to leave those at the door and just say, look, I'm losing money in this position. Got to cut it loose. It doesn't mean you're a loser. Doesn't mean you're a dummy, and doesn't mean you're a terrible investor. It just means you bought a stock too high and it's just not working for one reason or the other. Got to let it go. And
right, or the flip side.
Go invest that capital in something else that's working. You'll do a lot better.
Yeah. So, Lance, I've known you, and by the way, there's some market news I want to get to in a second. So, folks, we're getting back into the market data in just a moment. But I've known you for a long time. Correct me if I'm wrong, but I think you had a lot of these concerns about the debt and our deficit spending and all that stuff, and the potential repercussions of that pre-COVID, right? And if you had let those force you to say, I'm just going to sit on the sidelines, at the end of 2019, or even, oh gosh, it looks like there's this pandemic we're going into, right? And just sat on the sidelines since then, you would have missed your dry powder would have gotten clobbered with the inflation, right? The loss in purchasing power of wealth, over a quarter, and maybe even more. And you would have missed a tremendous run, in the equities market since then. And so again, that goes to, like, you don't always necessarily like how the markets are, but that's what you've got to trade given your position there as a steward of capital.
No, I've told you this before. Let me be fully transparent, right? I run a business managing money for other people. And if I had been sitting in cash for the last 2 years, I wouldn't have any clients left, right? They would have all gone somewhere else. And so I have to, so I do have a business to protect. And, a lot of people accuse me of talking my book, and hey, I completely understand that, right? When markets are going up and I'm saying, hey, buy stocks, everybody goes, oh yeah, he's talking his book. Yeah, I am. And because that's what's going on in the market, and that's what my book is doing. And so, yeah, we're gonna talk our book. If the markets are going down and we're taking positions off and we're raising capital, raising cash, I'm still talking my book. But there's always opportunity to invest. But that's my job. My job is to invest capital to create a return. But my job is also to protect capital during periods of volatility. And I think we've done a really good job of that. But it doesn't mean that will always be the case. I mean, I could wake up Monday morning and the market be down 30%, and our portfolio is not prepped for that just yet, right? I mean, so we would immediately have to start taking action. Again, we're overweight cash right now. We're currently running about 16% cash. We're underweight equities. We've got our duration on our bonds, and so the portfolio will hold up well. Our portfolio won't be down 30%, mind you. We'll probably be down, 8 to 10. If the market declines by 30, because that's about the beta of our portfolio right now. But again, we'd have to immediately start taking that kind of, some type of action. But again, that's, you're talking about a situation where we wake up Monday morning and we've shut down the economy again, right? And we're not going to be down 30% in a day. We might be down 30% in 3 weeks, like we were in March of 2020. That'll give us plenty of time to rebalance portfolios, hedges, put on hedges, take off equity exposure, whatever it is. But there's just certain things we're never prepared for, but that's where you got to really just set. And that's where, going back to emotions, right? That's where you got to really step back, not fall into that. I've got to sell everything right now kind of scenario, figure out what's going on, and then start making adjustments to the portfolio as you need.
Right. And again, we'll wrap this up real quick, but this goes back to what we've said many times in the past about, you want to play to probabilities, right? And you want to play to the most probable probabilities. And yes, you might want to have some tail hedges just in case the giant meteor comes out of nowhere, but that shouldn't be your plan A because that's got the lowest tail risk of happening, right?
Yeah, and that's a good example. Like I told you, we have a portfolio that runs options in it. We've got a real out of the money put on the S&P on that portfolio just in case, right? It's the just in case position. The stuff hits the fan, and it'll pay money, but it's probably going to expire worthless, and so that's insurance money that we just kind of spent, right?
Yep, just like fire insurance on your house. You don't ever root for the house to actually burn down, but in case it does, you got it.
I don't know. I'm kind of rooting for it lately. So
Yeah, well, actually, too. So I'm sure people have heard some background noises on your end here, maybe even seen some lights flashing in the background there. Folks, Lance was very transparent with me when we were getting on the cameras here that his home studio, as we mentioned, is still under construction. It's literally under construction as we're doing this. But kudos to Lance, just like the mail that needs to go out, whether it's rain or night or sleet or hail or whatever the saying is. He's that committed to getting these weekly market recaps out to you that he's willing to soldier through this.
Absolutely. So you may hear some bumping around. You may see some lights flashing in the background. We have an awesome electrical crew that has done just a fantastic. Sometime I'll have to show you a tour of the house because it's D&J Electric, by the way, if you're ever in Houston, so and need an electrician. These guys are fantastic, but some of the work they've done is just amazing. And when they finish up the studio, I'll give you a video tour of the studio because it's going to be really neat when it's all done.
That'll be cool. And again, we got to get back to the market data, but maybe later in the discussion, Lance, maybe near the end, you can give us an update on your cabinet maker because we had so many people in the comments wondering what happened. Did you actually have that discussion with them? So let's keep those hanging for that, but let's make sure we address that.
You got it.
Okay, so you mentioned a couple of times some of the data that came out this week that the market reacted to. We did get new inflation data, and we also got some new jobs data. What's interesting about inflation is CPI came in, headline CPI came in at 2.5%. And I just want to go back when inflation was, raging at like 9%. Both you and I, we're telling people, look, expect this inflation coming from here. And we went into the base effects of the math and all that stuff. And I think, old news now, but that has clearly happened. You and your partner, Michael, have been very confident that inflation was going to get tamed at some point because that's an integral part of your long bond position. So, a lot of people think headline CPI has a lot of problems in it. It certainly does. But it is optically very important, and there are lots of things that key off that index. So the fact that it's back now at only 2.5 and likely momentum continuing to the downwards, I think is important. You mentioned that some of the core CPI numbers were a little bit hotter than expected, not incredibly so, but a little bit hotter. And inflation, services inflation still remaining sticky, which I think gives people some pause that maybe that might make the difference between a 50 basis point cut and a 25 basis point cut, and the Feds maybe can't be quite as aggressive because inflation is still a little sticky in some of these areas. And as you said, the market actually sold off on that news, right? It wasn't the market wanted worse news basically so that the Fed would have more incentive to do a cut. And then of course that sell-off got reversed when the Nvidia news came out. But we also similarly had news that wasn't as bad as the market wanted with the jobless claims. Initial claims are still really surprisingly low, and continuing claims are rising, but not at an alarming pace at this point in time here. But what's interesting is if I looking at the headlines now, we'd heard nothing. I mean, nothing up until the correction a few weeks back of rewriting down payroll numbers, by the 800,000+ or so for 2023. But up until that moment, nothing except that the job market was resilient, stronger than expected, et cetera. I'm now seeing articles that are talking about the job market as fragile. like we've gone through the sentiment shift of like we have this incredibly healthy patient to all of a sudden, oh my God, this guy's really in big trouble here. And let me just mention this quote here, because in the past like day and a half, expectations for a 50 basis point cut have started rising again. Here's the quote. If I were in the room, I would actually be pushing for a 50 basis point rather than 25 basis point cut, Evercore Chairman Emeritus Ralph Schlosstein said in an interview with Bloomberg TV. The balance of risks have shifted from a risk that inflation doesn't come down as we hope to a risk that unemployment grows up faster than we would hope. So all of a sudden, it seems like the market has, instead of worrying about sticky inflation and all that stuff, and we've got a very strong jobs market, is all of a sudden, okay, yeah, the inflation job's pretty much done, but oh my God, we're really worried that unemployment's going to start getting fast quickly. So how important is this sentiment shift that's going on right now? And are you surprised by how quickly it's moved here?
No, no, I'm not, because the data's been tracking this for a while. I mean, I've just wrote an article today on our website.
Okay. Well, and just to pat us on the back, we've been ringing the warning bells in the jobs market for like a year. So, I feel like it's validation for us, but the fact that the market is finally waking up to this, right?
And like so again, the importance about, and again, if we kind of look back at some of the data, this is full-time employees relative to the working age population. That just rang a new low for this cycle. And again, that's coming down, sharply from where it was even last year. So, when you have these sharp drops in full-time employment relative to the working age population, that tends to be pre-recessionary in nature. You kind of see it back over here in the late 90s. But again, the trend of full-time employment relative to the population is very important, because full-time employment is what generates the wages and salaries to actually support economic activity. It's hard to raise a family of 2 or 3 or 4 on part-time jobs. Part-time jobs don't pay benefits. They don't pay, 401k plans, paid vacation, sick leave, and child care support, and all this. You don't get that from part-time jobs. So full-time employees are very, very important. And if we look at full-time versus part-time, we're having a lot of part-time hiring. Full-time jobs are being lost, and full-time employment on a year-over-year percentage change is negative, which is always pre-recessionary. So again, you've always got to be careful with data like this. Just for one reason is that you look at when full-time employment is an example, the year-over-year rate of change goes below 0, it always aligns with the recession. Just remember that recessions won't be dated for 6 to 9 months from that date. So, the gray bar will show up here eventually whenever we have a recession, but, it just does tell you that the economy is running a whole lot weaker. And the purpose of this article is to go through and explain why full-time employment is so important relative to earnings. And particularly in the economy itself, because that's where earnings come from. So there's not surprisingly, there's a very high correlation between economic growth, employment, and the annual rate of change in earnings. And again, as we've talked about before, so goes earnings, so goes the market. So again, you've got to pay attention to the annual rate of change in earnings. And right now, estimates are extremely high for S&P 500 companies going into next year. But the employment data, to your point, certainly doesn't support the narrative that we're going to have this 20% increase in earnings growth between now and the end of 2025. There's going to be a reality that markets are going to have to ultimately come to grips with. And it doesn't mean the markets have to sell off to a huge degree, but they've got to come to grip with a slower earnings environment that would translate back from a slower employment and economic environment. Again, market valuations, we talk about the current valuation level in the markets, and we're like, oh, valuations are so high. Well, that's because market valuations reflect the change in earnings estimates. If those earnings estimates start to come down, this is the point. If earnings estimates start to come down because you have slower economic activity, which slower economic activity comes from employment, then the valuations are going to have to reprice for those estimates. And again, you take a look at, and importantly, you take a look at the S&P 500. Almost all of the earnings growth has come from 7 companies. If you take a look at the S&P 500, 493, there's hardly any earnings growth coming out of those 493 companies. All the earnings growth come from the Mag 7. So there's some real challenges moving into next year, and it's so important to remember that the economy in order for the economy to grow, and this is why employment is the most important thing. This goes back to your hope framework that you've talked about before. The economy is a consumption based economy. 70% of our economy comes from consumption. Well, you can't consume unless you go to work, earn money, and have something to consume with. So you have to produce first in order to get a paycheck, in order to go buy something. Well, if you're not working, you don't have a paycheck, which means you can't buy anything, which means consumption, which provides the revenue for companies. And of course, revenues minus expenses equals the profits. All that begins to decline as you have slower employment growth. So again, the real risk over the course of the next, and again, this doesn't mean the markets are going to crash. I'm not saying that at all. But there is going to be a realization that earnings can't grow at the rate that they're growing now if employment is slowing. And I think that's the concern you're starting to see crop up. I think, we've been talking about this for a while, and now the rest of the market's kind of playing catch up to us. And I think they're going to come to that realization that these earnings estimates have to come down going into next year.
Okay, so this is what I talk a lot about, especially after having folks like Peter Atwater on, the behavioral economists, which is all about confidence and sentiment, right? And it's hard to get a big shift in the market without a sentiment shift, right? They tend to go hand in hand, and so you have to be watching for when sentiment shifts. And you also have to realize that sentiment can shift very quickly. The difference from net bullish to net bearish at the end is really just one player, right? It's that one person crossing the line, and then you have a preponderance on one side, and oftentimes builds steam. And that's why I'm kind of trying to see if we're maybe calling something here in real time when the market goes from not being worried at all about the employment side, which again, not my framework, the hope framework, that's Michael Kantrowitz's, just to give full attribution. That E has been the bulwark. That really what kept the economy out of recession coming into 2023 when everybody thought we were going to have one, right? So if sentiment is now shifting on employment, that could, to your point, then lead to perhaps force a repricing where people say, hey, if I've actually changed my mind, now that I'm looking at all my models, I don't think earnings are going to grow that much, and I got to start writing these things down more, right? So we'll see if that happens, but it's the sentiment shift seems to be happening right now. We'll see if that continues.
And then we're seeing this in corporate announcements, by the way. Corporations are talking about slower consumer demand. They're talking about trying to cut back on wages in some shape, form, or manner. We've seen jobs that were listed a year ago now being listed for 20,000 less a year than they were. So, they can't necessarily just, we haven't seen the layoffs show up, but we're certainly seeing it in some of the other factors that relate to employment. And again, corporations are starting to talk about, the slowing consumer, the impact on their business, the things they're concerned about. So it is starting to show up.
Yeah, and it is interesting. I should try to get a labor specialist on to give us the real data, but I agree. We're not seeing layoffs at the scale that we see, in some of the past recessions. But the headlines, if you follow these layoff tracking sites, which I do, every day, there's concerning news and war notices have exploded and all that stuff. And it's interesting because I look at one set of data and I feel like, oh my gosh, things are really getting worse. But then, you look at other sets of data and you're like, it's not really that bad yet. So I'm scratching my head a little bit. So folks, I'll try to see if I can get a labor data and to give us sort of the true sense of where things are. But Lance, to your point about we have a consumer-driven economy, and obviously if consumers aren't working as much, they can't spend as much, right? That all makes total sense. I'm 100% in agreement. But it's not just the earning part, right? It's actually what you have left over after you've paid your bills, right? And it's interesting that the headline CPI, like we said, is down at 2.5% right now. Honestly, I don't know any real people who say that their personal cost of living growth is only down at 2.5% year over year right now. How long do you think it's going to take, if at all, before the cost of living normalizes to what we're being told the inflation rate is? Because I'm still seeing things like people complaining about, oh, my property insurance just went up 30% if you live here in California, right? Or just, oh my gosh, this thing that I buy at the grocery store, yeah, it just went up 18% from last year. You know, they just changed the prices. I'm not hearing stories of, oh, actually, you know, things are getting either cheaper for me. No one's saying that, but I'm not even hearing people saying like, oh, phew, finally, you know, the cost of living increases seem to be moderating here. So, you know, that depresses what people are able to spend too.
Sure. So two very important things. We had this conversation this past week on the radio show as well, is that there's two important things to understand about inflation. And the first is that the inflation rate for you, Adam, in this particular case, I am talking about you. You live in California, right? So what you pay for a gallon of gas and what I pay for a gallon of gas are two very different things. You know, gasoline in Houston is now less than $3 a gallon. So it's definitely come down with falling oil prices. But you know, your cost of housing in California and my cost of housing in Texas are two very different things, right? So my homeowner's equivalent rent is far less than your homeowner's equivalent rent. Actual rent of apartments are very different between the two. So, you know, the important thing to remember as individuals is that your personal rate of inflation is not calculated in CPI. So when you look at CPI, it has nothing to do with you. This is based on averages around the country, and they're not really great indicators of inflation. Remember, importantly, in 1997, 98, don't quote me on the year, but somewhere right around there, the Clinton administration hired Michael Boskin and the Boskin Commission to come in and recalculate how we calculate inflation. We used to just work off a basket of goods, and we just reprice that basket of goods every year, and that was good enough. The problem was that inflation was growing over time, and as it should be, because you have the economy's growing, but it was requiring the government to pay more and more out on Social Security. So Clinton wanted to balance the budget. So it was a couple of things that he did during his administration. Like, for instance, he recalculated the way that we calculate employment, immediately removed 500,000 people from the roll. So it made employment look a whole lot better. Then he wanted to basically balance the budget. So he borrowed $2 trillion from Social Security, put it on the budget. And for about 5 seconds, we had a balanced budget and we were running a surplus. Of course, that's now come back to roost, you know, later on. The other thing he did was, in order to reduce the amount of Social Security payouts that we made every year, which are based on inflation, right? So Social Security gets a COLA adjustment every year. And that was based on inflation. So if I can lower the rate of inflation, my COLA adjustments go down. And so Michael Boskin and the Boskin Commission came in, recalculated the way that we calculate inflation. This is how we added hedonics and all this other stuff to inflation to bring that inflation rate down. So inflation has nothing to do with you. So here's the important thing to understand about inflation, the way it's reported. First of all, the market doesn't give a rat's behind about your personal inflation. All they care about is the inflation data. What does that mean for the market? So reported inflation that comes from the government is all the markets care about. So if you're investing, as we talked about earlier, leave your personal emotions aside. That means your personal view on inflation. Leave it at the door. It has nothing to do with the financial markets. What the markets are looking at is, what does that CPI say? What does that mean for monetary accommodation? What does that mean for corporate profits? What does that mean for earnings? That's what the markets care about. They don't care about anything else. The other side of this is that when you're looking at your personal rate of inflation, remember that inflation, the Fed wants 2% inflation, right? They want prices to go up 2% a year. So a couple of things you need to understand about inflation. We wrote a report on this earlier this year. When the core rate of inflation was, we had a big jump in inflation, kind of the core pressures earlier, and there's a big jump in insurance, exactly to your point, Adam. There's a big jump in insurance. And it's like, man, look at this huge jump in insurance. Well, yeah, of course, because every year, all your insurance premiums reset at the beginning of the year. You have open enrollment in November, December for your insurance. And then starting in January, all those premiums reset. So you get the big increase in insurance, and then it moderates out the rest of the year, because your insurance payment doesn't change from month to month. You know, you get your health insurance from your business or your company, whatever, and you make the same monthly payment until you re-up for the next year and you get the new rate. And this is why companies are always fighting with their benefits providers, trying to keep that rate down as much as possible, because it goes up every year. The same thing goes with housing. For most people, your housing is fixed. Your mortgage payment doesn't change with the inflation rate every month. If you've lived in your house for 30 years and you've been making a 30-year mortgage payment, your payment never changed. You've been paying that same payment for 30 years. So what the markets are doing is they're adjusting on a monthly basis, saying, okay, if you could rent your house, so they come to me and they say, Lance, you've got a house. If you could rent it out this month, what could you rent it for? I could rent it out for $5,000 a month. I'm picking that number. Next month, maybe something's happened in the markets and there's been a decline in something, and I'm not feeling so confident. They say, well, Lance, what could you rent your house out for this month? That's $4,500. I have no idea. I'm living in the house. I'm not renting it out. It's just an assumption of what I could rent it for in the overall market. Then they take that and they impute that into the CPI calculation. But for most people, their rent doesn't change for 12 months or 18 months. If you're renting an apartment, it doesn't change for the time frame of the apartment. But your inflation is always going to go up. What the Fed does not want is they do not want deflation. They do not want you to come out and say, man, prices on gas went from $2 or $4 to $1. That's terrible. Economically, that's a terrible thing to occur. The Fed does not want that. They want your inflation. They want everything you're paying for to go up at 2% a year every single year.
All right. So again, all that, and the point I just wanted to make is when you were talking about the employment data there and saying that jobs might grow more slowly than is being expected, or we get into even tougher times, maybe jobs shrink a little bit. And that's impacting people's ability to earn, which then flows in the economy. I'm just saying that as long as cost of living continues to be higher than maybe we're telling ourselves as a country, that's making that situation even worse, because that person has less money than they calculated left over to spend, and therefore that should pull earnings down even more, corporate earnings down even more. Secondly, go ahead.
But I will tell you where inflation matters in terms of your personal rate of inflation, and that's how you feel about spending money.
Sure.
So if you're living paycheck to paycheck right now, and you're a man, it's like every time I go out to eat, it's like $60. I'm just not going to go out to eat now, right? McDonald's has been extending their $5 value menu now because their customer base they're trying to get some of their customer base back, because people just can't afford, you can't go to McDonald's, and spend $60 eating at McDonald's. It's just crazy.
And I'm surprised by those headlines, like, McDonald's announced that they're going to have to extend it. It's like, did you magically expect everybody to be able to afford more food after just doing this for like 2 months, right? I mean, people they're still trending downwards here, right? You might need to go to the $4.50 meal.
No, it's exactly right. But that's where we go back to talking about employment. That's where we go back to talking about personal. So your personal view about inflation, again. So what the markets care about is what the government reports. But your personal view of inflation is important, because that's what impacts your spending habits in the economy. And if you contract spending because of the cost of living, then that's going to impact economic growth, slow that down, which is then going to start the reversal process of inflation, which is now companies have to start cutting prices in order to sell stuff. And again, if you take a look at CPI versus PPI is a good example. If you take the spread between CPI and PPI, it will tell you whether or not companies are having to retain inflation, or whether they can pass it on to consumers. And right now, companies are having to retain the inflation because they can't pass it on to consumers, which is going to impact their profits and earnings.
Right, and because the consumer is pretty tapped out at this point. Right?
Exactly. Well, that's why, right? I mean, companies can lift prices to the point that eventually, so let's say that you and I produce a widget, and everybody wants to buy our widget. And Adam's on social media touting our widget, so he's our paid influencer. Well, we're selling that widget for $10, and so we're selling them out the door like hotcakes. And so we go produce 100,000 widgets because we're going to sell them all at $10 at $100,000 to 100,000 people, and it's going to be great. We're going to make $1 million. It'll be fantastic. And all of a sudden, our sales decline because nobody can afford to buy them at 10. So now Adam and I have a choice: either we can keep them listed at $10 and not sell any, or we start cutting it 9, 8, 7, 6. Everybody buys them at 6, right? So there's our new number. but that's how companies have to respond to inflation, and that's why when they have to retain that inflation, I can't pass it. As long as I can pass that inflation on to consumers and they're willing to buy it, fantastic. I'll sell it at $10. But if they're not willing to buy it because the price is too high, I'm gonna have to sell it at $6.
Okay, so and we'll see we'll see if this is where things continue to trend. It seems that they are now trending in this direction. The other question I just wanted to ask is, you in the data you were showing basically jobs per capita, right? And I'm just trying to get a sense. We've had in the media, and we've even talked a fair amount on this channel here about the tremendous wave of undocumented immigration that's happened over the past couple of years. And I'm curious how you think it impacts that trend, because we don't have data on those people. And if you think, let's just pick a round number, 10 million, might be less. Some think it's less, some think it's more. Some think it's a lot less, some think it's a lot more. But let's just, for easy sake, there's 10 million people here that we don't have a lot of visibility into. Now, granted, they're doing mostly jobs. If they are working, they're doing mostly jobs lower on the earnings spectrum. So that already is not maybe driving averages. It's bringing the average down. But then the question is how many of those people are actually working and having a positive impact on the economy versus coming in and either not being able to find work or for whatever reason, on a net basis, taking more from the social support system than they're contributing into the system. I know you have imperfect data here, but what do you think? Is that illegal immigration making the situation worse or better in terms of that employment per capita chart?
So if you go back and look at that chart, right? So that was full-time employment relative to the population, right? So or the working age population, right? The labor force. So we know, right, from data that, for instance, in New York, they were providing housing for illegal immigrants or providing them cash to live on, those type of things. Here in Texas, when they were crossing the border, they were giving them a $5,000 Visa card and all kinds of other stuff. So we know they were getting support from the social network through the NGOs, through states, whatever.
Hospitals, all that stuff, yeah.
Hospitals, sure, all that. So great, and we talked about this before. As humanitarians, that's fantastic. We're helping people. But the problem is those individuals are not taking full-time jobs, right? So if you think about labor in terms of full-time employment, illegals aren't taking that employment. What they are taking is they're taking over construction jobs, restaurant jobs, most of them, and the vast majority of that is part-time work. And even the Federal Reserve, Jerome Powell made this I wrote an article about this a few months ago when Jerome Powell made this statement. But Jerome Powell even made the statement talking about illegal immigration, saying that these people have a much higher work ethic, but will work for less money than American workers. And so the natural tendency for corporations, and particularly in an environment where earnings growth is under pressure, is to hire higher producing workers that have a strong work ethic that they can pay less money for. But those are primarily in part-time jobs. That's why we're seeing so many of the part-time labor jobs increase versus full-time employment.
Yep. But I guess my question is, and I don't purport to really know the answer here, is on a net basis, when we're talking about macro future of the economy and the jobs market here and value creation from the workforce, is this having a net positive effect, do you imagine, or is it having a net drain effect?
No, it's a net drag, ultimately. Because again, so it's a net drag for a couple of reasons. So wait, let me back this statement up real quick. Let's go. Is immigration itself, is immigration a positive or a negative for the economy? It's absolutely a positive.
Absolutely a positive when done right. Yes, absolutely.
When done correctly. And this is where we talk about merit-based immigration, et cetera. But we have the lowest birth rate in the economy since 1940. As so goes demographics, so goes your economy. Again, so we need demographics. We're not producing enough natural-born population across the entire country. So that means we need immigration. But when we're specifically talking about immigration in this context, we're not really talking about merit-based immigration where we're bringing in doctors and manufacturing people that have capital to invest in the country, and they want to come in and they want to build a business that hires employees and puts, increases capex into the economy. We're not talking about that. We're talking about people that are avoiding the legal system and coming around the ends. And again, these are humans, and we have a responsibility to some degree to take care of people. I mean, it's just as a Christian, that's where, we all struggle with kind of the immigration topic. But, we need to bring in individuals that are contributing at a higher level in the economy. So, when you have a lot of individuals that come in, and let's just keep things very basic for a second. Let's say that, just as an example, that we have 50 million people in the economy, right? And so we immigrate 50 million more people. So now we have 100 million people in the economy, but the 50 million that we immigrate are all working at minimum wage or less, right? Because, or say even $15 an hour or less, they're working, restaurants and leisure and hospitality. Again, when you take a look at our recent hiring reports, the vast majority of jobs that are created are leisure
in those areas,
restaurants, et cetera. Those are all lower wage paying jobs. So this is what I mean by the impact of the economy. The 50 million people that were here, their average salary was $50, right? We immigrate 50 million more people, their average salary is $25. Well, now the blended average salary is the average of those two. So we're no longer at $50 an hour minimum or average wages. We're now somewhere around 33, right? And so all of a sudden, we've lowered the overall wage growth of the population by immigrating a larger number of individuals that work for lower wages. And so as a net drag, which provides now a net drag on the economy, because the average wage is reduced, which means that even though we have more people in the economy, as the economy grows, it can't grow as fast because the average ability to consume declines.
Okay. All right. Got it. All right. Well, look, yeah, I'm sure this is not the last time we're going to talk about this, but I got to move on to some other points here. The ECB cut rates this week.
Yes.
Right. We're already, I think, seeing momentum build globally from a rate hike regime to a rate cut regime, and obviously the Fed is highly expected to follow suit this month. In many ways, we are moving from one era to another, right? I mean, even though the Fed has been in a tightening regime, it maybe hasn't quite felt like it because the fiscal side has been spending so much. But now it looks like we're heading back to where central planners, pretty much worldwide, are back to easing, right?
And that's gonna continue, right?
Yeah.
So this is the start of it right now.
Well, and on that part, I interviewed Gordon Long earlier this week. Another great interview. Gordon very kindly prepared a bunch of visuals that he walked through in that discussion. Folks, if you haven't watched that video yet, you should watch that too, in addition to the Jem Carson one. And Gordon had kind of both a very depressing but also optimistic message, where he said, look, we've got, our central planners are stuck in a debt trap of their own making, right? And that debt pile is going to get bigger. It just, it has to, for the game to continue on, for the machine to continue working. That debt pile must grow, and the central planners must do whatever they have to enable that debt pile to grow. So he said, look, the downside is there's all sorts of knock-on effects of that, and eventually, that game is going to come to an end at some point in the future. But he said the flip side, the optimism side for investors, is it means that these guys have sort of fewer options available to them, and so we have a higher degree of confidence as to what they're going to do. And so, in investing, you always want to invest where odds are in your favor, right? And he's basically saying the odds are getting into our favor for certain outcomes here. But anyways, I just wanted to score a couple things around that. One, debt continues to accumulate. The U.S. fiscal year ends next month. It'll be the first fiscal year in history where the U.S. debt interest exceeds $1 trillion. We've been told that we are on track this fiscal year to pass $1 trillion for the first time ever in debt service. We actually have, as of this recording, Lance, we're over $1 trillion. It's going to be $1 trillion something by the time the fiscal year ends. So, we are absolutely, continuing to rack up, massive amounts of debt and debt service costs along the way. This week, we found out that the deficit in August, just in 1 month, was $380 billion, gargantuan amount. It was 90 billion more than what the expectation was. The expectation was for 292 billion, which is a phenomenally big number in and of itself. But we blew through that by $90 billion in a single month. So, we are showing zero constraint right now on the fiscal side of things, and that is likely to continue from here. I was reading an article that was talking about this level of spending, and they described it as a metric ass ton of spending. I thought that was really funny to see in conventional financial media, somebody actually resort to that in reaction to the numbers that we're kicking around here. But basically, Gordon says, look, just expect this to continue. What that can lead us to expect over time is that they're going to have to lower interest rates to try to make this debt as less crushing as they can. And obviously, the big reason why we're over $1 trillion in debt service right now is because interest rates have risen so much over the past 2.5 years. They're going to do everything they can to try to start getting those interest rates down to ameliorate the pressure of that debt service cost while the debt pile still goes up. And he does expect, kind of on a secular level, that inflation is going to be at a higher baseline going forward over the next decade or two, which I think you do too, Lance. I know you think it's going to come down in the short term, but I would think you would agree with that. But obviously, if you think differently, let me know. I'll take a pause here because there's one more part of the story I want to mention. But anything you want to say about what I just rattled off here?
Oh yeah, I mean it's just kind of back to the whole frantic. It's the debt thing. But look, bottom line is that debt. Yes, we are issuing a lot more debt, but remember, it's a function of the economy as well. And so when we start looking at debt versus economy, so this is debt to GDP. Despite this surge in debt since 2020, debt to GDP is actually declining because economic growth is growing. So deficits and debts, yes, they do matter. They do lead to slower rates of economic growth, but it's not like debt to GDP is just surging off the moon. We're not into the Japan syndrome just yet. Certainly elevated, 121% of debt to GDP. That's nothing to laugh at. Over 100% of debt to GDP, you clip off 1% of economic growth. But again, a lot of the hand wringing and a lot of the analysis that you just kind of spewed out, oh, it's an ass ton of debt. Well, first of all, you got to remember that it's a lot of short-term bills because interest rates are high, and the Treasury is doing the right thing here by issuing short-term debt that will mature fairly shortly. As rates come down, then they'll issue out longer-term debt and lock in those lower rates. But to the point about higher inflation, again, that's a function of debt. If we do continue to pile on debt, as we are, and I'm not arguing that at all, that debt is non-productive. So it leads to lower rates of economic growth, which leads to lower rates of inflation. So inflation is going to settle down at some point below 2% because that's where economic growth will be.
Okay. We'll be tracking this, and we'll see what lies in the future here.
It's going to take 20 years.
Yeah. So, Gordon's message here.
I'll be talking on this. I'll be retired for sure within 20 years.
Maybe, but yeah.
I'll be 8 years old. But
he was talking about these as sort of secular trends, right? Again, this is not an investing strategy for the next couple of months. This is sort of how to think about the next decade or two. But it becomes important. Yeah, it becomes important because you begin to see things like we just saw in China, where they just raised their retirement age, right? Which is, to deal with this stuff, again, the debt pile must grow, right? That's kind of, if you want to preserve the status quo and you're in charge of making that happen, that's what you got to do, right? And so you will increasingly do whatever it takes to keep that going, right? And so my point is like, go ahead.
But there's a huge difference. In the US, the economy is growing. In China, it's not. And there's a big difference between what's happening in China and what's happening in the US. China spent years building entire cities that nobody lived in to artificially inflate GDP. And we said back then that that's just a function of time until that chicken comes home to roost. Well, it's come home to roost for China. They're gonna pay their way out of this over time by government interventions, et cetera. But they're a communist country, so they can do that. State intervention will solve these problems for China, not to the benefit of the Chinese population, mind you. Their cost of living and their ability to live will continue to erode over time. But that's what happens under communistic, socialistic regimes. And that's why you should really do everything you can come this November, not to push us further into socialism by doing, down payments for housing and, free this and free that and childcare and all this other stuff, because that does not that does not work to increase economic activity or increase economic prosperity. So, but again, the economy is growing here. So yes, the debt is going to grow because our economy is growing and because we're spending money on all these other things that we think are good things, right? How much money, as a good example, how much money did we spend on solar incentives, right? We spent billions in taxpayer money to support solar energy because it was the green thing to do. There's been over 250 solar farms that have gone bankrupt now, just in the last, and over 100 this year so far. So all that money that we spent, taxpayer dollars, which came from debt ultimately, went to failed projects and failed businesses. But this is why the government should never be involved in doing things like picking winners and losers. If you want to incent the solar industry business, that's fantastic. Provide tax incentives to the actual businesses and say, look, if you can grow your business, then we're going to give you, a discounted tax rate for whatever to help you grow over time. But don't do tax incentives, don't do subsidies, don't do those other type of things, because that just wastes money because you're picking winners over losers. But this is the problem that we have, within our government. We just keep using money to produce non-productive investments. That all comes from debt, and that does not create economic activity.
So totally agree. So again, I'm not making, look, there's a reason I live in the US and not in China, right? But I think there's perhaps maybe more similarities than you're giving credit here in terms of, China's economy is still growing too, right? Growing faster than the US economy, but it has it's all its own issues. But the issues are largely the same in terms of China's been levering up like crazy since the global financial crisis. It has an aging demographic, even worse than here in the States, but we have our issues, and you already mentioned them, right? So the point is like, they can do the heavy-handed stuff sooner than we because they are a command and control company. So all I'm trying to say is basically look at what's happening there as sort of a preview of coming attractions here, which is as long as that debt pile needs to grow and potentially economic growth, slows going forward, they're going to do more and more stuff that maybe we might not be able to imagine today to keep the game going. And it could be, some of your retirement funds need to be invested in government bonds. It could be, okay, Social Security is all of a sudden being means tested. And if you have above a certain net worth, you don't get it anymore, right? Retirement age could go up. There's already lots of discussions about that. Should we raise the Social Security age? So all I'm saying is, as this game continues, be aware that the rules will likely get changed to keep the grand game going here. And to your point, yeah, not in the interest of the Chinese people, but in a lot of cases, probably not in the interest of the American people either.
Oh, that's right.
Okay. All right. Well, look, we're going to start wrapping things up here. Let's get to trades, Lance. Given this market volatility, what trades have you guys made? It sounds like you took some VIX hedges up.
No, we added some. We actually bought just today, but only in one specific model that we have that we run options in for a very specific kind of group of investors. We added some VIX hedges, but no, and the rest of our portfolios, the vast majority of them, we haven't done anything this week. We'd already done kind of all of our profit taking previously before this correction started. But probably early next week, we are going to start reducing exposure to our alternative AI trades. And we wrote about this sometime back, talking about artificial intelligence and the power generation needs that those companies were going to need, right? So data centers are going to need a lot of power. And our current electrical infrastructure really doesn't support that. So we bought companies that in the utility space, and they've had just a phenomenally strong run over the course of the last couple of months. We thought this was going to be a trade that would take a couple of years to play out. It all happened. Everybody else got on the same trade, kind of after the fact. And, so a lot of these stocks are up 30, 40, 50% in just a matter of a few months. So we're going to probably be taking profits in utilities next week. Real estate's done fantastically well. So we'll probably take some profits in those sectors as well. And then probably look to rebalance back into some of the mega caps, whenever we kind of get a good signal, and probably put some of that exposure back on.
Okay. And in those sort of alt AI play companies, is that mostly profit taking, or are you going to be closing positions?
Oh, no. Just the long term, our thesis is, and we wrote a whole article on this on the website. Let me see if I can just find that article real fast. There you go. It's called Electricity Demand May Cure Debt Concerns. And we're talking about, and again, just exactly to kind of the point that we're talking about. Right now, we spend a lot of money on non-productive investments. A very productive investment that we could do with debt would be a public-private partnership between the government and utility companies to expand, grow, and harden our power grid, which is both good for national security, but also the demand that we're going to need for electricity generation. So we wrote an entire article about the coming demand that's going to come from the generative AI market on energy companies. And from that, we kind of built out our thesis that over the next decade, that a lot of these companies, and we bought positions in American Electric Power, we had positions in Duke Energy, we bought a position in GEV, which is the GE spinoff recently in that utility space, and those have just all kind of taken off running. So again, we're overweight utilities. We overweighted that whole sector in our portfolio, and so now we'll probably just go in and reduce that back to our original target weight, and then wait for a better opportunity to add back to them down the road.
Okay, great. For folks watching too, just a quick commercial. The interview that is coming up after this one, so this is releasing Saturday, so the one's coming out on Sunday, is with Doomberg, energy analyst Doomberg, and we touch on this where Doomberg is very bullish on AI, very transformative. It is something that he believes that the nation has said, this is a race that we have to win, kind of like the space race or the arms race. This is something the US has to become dominant in. And so there's going to be just tons of investment going on in the space. There already is, no huge surprise to folks. But to win it, he says it's going to be won on the back of the country that is able to basically commit the greatest amount of low-cost energy, because AI is so energy dependent. And in the US, we have such a bonanza of cheap natural gas here that he sees natural gas as being a really key, strategic advantage for the US in this race. But also there's going to be just a ton of investment going into the natural gas space to be able to enable us to win in AI, leveraging the natural gas. And there's also other parts of the natural gas investment thesis that he likes too. But this AI one was a really big one.
Well, that's also, I forgot about that. Actually, we took a position in OKE is a symbol, and that we took a position in that earlier this year as well. And that was supposed to be our sleeper stock, right? It's natural gas pipeline. And we thought it was just going to kind of sit there and do nothing, and just, it spins off a nice dividend. It has about a 5% dividend yield on it. So we just thought it'd sit there and do nothing. And that thing's already up like 10% since we bought it. So, it's just that whole sector has just, attracted a ton of money flow. But Doomberg's right. I mean, this is the thesis that we built when we wrote that article about the AI demand for energy. And that was all. And again, as I've said before, if you go to realinvestmentadvice.com, we publish all of the stuff that we do in our portfolios what we publish on our website, our daily market commentary, our blogs that we produce 3 times a week, our weekly newsletter. That's all of our research, and all of that research backs up why we're making trades in our portfolios and managing our portfolios the way that we do. So, like this weekend is 3 market risks in the newsletter. Talking about 3 different market risks to pay attention to going into the end of the year. See, so I'm not bullish, even though
So what?
I'm not all bullish, even though I've got my bullish friend back here. So
I love when the bulls come up because you have these big longhorn horns coming out of the sides of your head.
Texas, of course, we have longhorn bulls.
All right. Well, look, as we wrap up, two kind of human interest things I want to talk about. I was just at my 25th reunion for Stanford Business School, and there were some interesting takeaways from that I want to share briefly, get your thoughts on. Secondly, I want to give folks an update on whatever happened to Cabinet Guy, so I haven't forgotten about that. Yeah, this past weekend, I went back to Stanford for my 25th business school reunion, and it was a great experience. And I actually found that a number of my classmates who I hadn't talked to in certain cases for like a couple of decades watch this channel. So it was kind of fun to have people come up and say, "Hey, I really like what you're doing at Thoughtful Money," and you got some fans there, Lance, as well. But it was really interesting. I've always thought of myself as a bit of a, I don't want to say a black sheep, but like a different drummer than the average person who's in my class. And I think that's still relatively true. But that being said, it was a great reminder of just the high quality of caliber of people who was fortunate enough to be included in when I went there. And it's funny, like, it's definitely a great advantage in life to go to a place like Stanford Business School. It's definitely a two-edged sword. You meet people there. You know, a lot of the classmates there are world beaters, and so you're just striking up a conversation, talking with somebody, and you're like, oh, okay, this person was an early investor in Facebook and in Uber and all this. Like, oh my God, this guy's net worth is like freaking off the charts. What the heck have I done with my life, right? And there's past Olympians there. There's people that are running some of the world's biggest nonprofits and making amazing changes in the world. So it definitely is a license to feel really insecure about yourself and your contributions. But what was interesting is a couple of things. One, these people are all optimists. And I think this is going to resonate a bit with you, Lance, because it goes to sometimes how you describe your approach to investing. They don't worry that much about a lot of the issues that we talk about here at Thoughtful Money. They don't worry about the debt pile and the eventual reckoning that we're going to have with that. Almost nobody had heard of concepts like the fourth turning. And they don't really concern themselves with that, to be honest, right? And it is, maybe you could call it a willful blind spot that they have. But these people are entrepreneurs, and they have faith that if they work hard, tomorrow is going to be better than today. And hey, if we get the right people together and we work really hard, we can do something really great here. And if curveballs happen, if there's a market correction, a recession, whatever, something like that catches them by surprise, they've got the confidence that, like, okay, yeah, we'll get hit by that, but then we'll figure out a way around it. We'll pick ourselves up. We'll dust ourselves off. We'll figure out how to do better, right? And that has served them really, really well. These people are really successful. Now, one can argue, hey, they kind of came into maturity at a great time where there was 20 years of the Fed basically having the markets back and capital being really cheap and all that. And I think that is a big part of the equation. I don't deny it. But I also think that if you don't go out of the cave to go hunting for big game, you're never going to catch big game. And that's what these people do. Every day they go out there and they've got the confidence. I'm going to grab my spear and I'm going to come back with a mammoth. And if I didn't get it today, well, I'm going to go get it tomorrow, right? And to your point about investors, you don't want to be so concerned about the big risks, especially if they're not imminent ones, right? If they're big tail risks. That you don't leave the cave, right? Or that you don't get into the market and you just stay, on a bearish sideline for too long, such that, the party happens and you basically just watched it pass by, right? And, when you really consider it, like, none of us has had an injury that has proven fatal so far, because we're still here. We're by definition, we're alive, right? Where this sense of like, I'm not going to worry too, like, I'm not going to worry too much about the risks so that I don't take action, because I'm confident that no matter what happens, I'm going to get beyond it, right? That mindset, I think, certainly has been a huge explainer of the success of the folks that I went to school with. And I wanted to bring that back a little bit for us, because I think in some ways we have some advantages where maybe we're aware of some shoes to drop that these folks aren't, right?
Yeah.
But it can also really limit us if we let it, influence our thinking too much.
So the reason that optimists always are the ones that are successful, and again, you Tony Robbins or anybody else, and your whole group of of classmates, you should learn that lesson, which is that optimism is what drives you to move forward and to take the chances and take the risk to make money and to build wealth. And until you can adopt that mentality, you're only limiting your ability to become wealthy over time. And this is really true for young people. And I get a lot of emails from some of your viewers that are in their early 20s or even early 30s. God, I'm so worried about what's going to happen because of this. And I'm like, dude, you just should be buying an S&P 500 and dollar cost averaging all you can into it every month, because you'll have a lot of wealth by the time you get to retirement. So, the message that you want to deliver, you should always be delivering a message of optimism. You should always be delivering, hey, yeah, this is an issue, but we're going to overcome it, because we will. Look at the issues we have overcome throughout the history of the United States. Whether it's world wars or whether it's the Depression. I mean, if there was ever a case where you would go, oh my gosh, I'm just, never going to do that again, that's the Depression, right? And there was a lot of people that came through that Depression and never invested in the financial markets ever again. They wouldn't even put their money in the bank. They just left it, and they would literally, the whole thing about putting money under your mattress, that's literally what they did. They never
literally happened. Yeah.
And what did they do to themselves? They didn't become wealthy, right? They limited their ability to grow. So optimism is such a key, important part of your investing mentality and your ability to be successful in life. Anything, and this is something that, again, like I told you before, I'm inherently bearish. But what I have to do is every day, look, I run a business. I've got to grow my business. Every day I'm optimistic that, okay, yep, that's a challenge I've got to get over. We've got a problem here. We've got a hurdle. And every day we grind and we push until we get over that hurdle. We move forward. But we're optimistic that our business is going to continue to grow. We're optimistic that our portfolios will continue to perform. And are there going to be hurdles? Are there going to be bumps along the way? You bet. Are there going to be things that happen along the way? Absolutely. And we'll adjust and we'll start growing again. And that's the way you've got to approach not only just your investing, but also life in general. Because if your whole outlook is the end of the world, doom and gloom, nothing good is ever going to happen, that's what you're going to wind up with. Every day you roll out of bed, you say, I'm going to go conquer the world today. And if you don't, that's okay, because tomorrow we're going to go do it again. It's like Pinky and the Brain, right? Every day you should be plotting how to take over the world. That should be your mission every single morning when you wake up.
All right, so I'm not disagreeing with that part. We all know people that YOLO'd into Dogecoin. I mean, look, there's ways to be irresponsibly optimistic, right? And you have hedges in a portfolio, which makes sense, right? I mean, the thing is you want to capture that fire, but you don't want to be reckless, right? And so, but my point is, which I think we agree is borrow that sense of optimism as a motive power, right, to keep moving forward. And also the thing I just want to make folks aware of too is, like, if you're expecting something like something very dramatic to happen, right? We're going to have some phase shift in the economy, and we're going to go into some period of time where it's going to be a lot harder, right, during there. I don't disagree that we shouldn't worry about recessions and stuff, and I talk about it all the time, right? But these people are the people who are running the show. Their DNA is much more indicative of the folks that are running corporate America, right? They're going to wake up every day and say, how do we get beyond this thing, right? The economy is over time going to continue to grow, right? And so, asset prices will continue to go up over time, right? So what you don't want to do is be putting yourself in front of essentially a force of nature, both human nature and economic nature. Now, again, I think you need to be practical and pragmatic and say, hey, there are times when valuations get too overstretched, or we're looking at the economic data and it looks like rougher times might be coming on ahead. But again, don't put yourself in this position where you're saying, that's it, I'm out, I'm never touching this stuff again, or I'm putting myself in a position where I could be out of the market for years, where this whole herd of world beaters, is eventually going to take things higher, and you're going to miss out on that. So I think we're saying a lot of the same things.
Well, yeah, look, I'm not saying be optimistic and go be stupid, right? Don't go take reckless risks. That's not being optimistic. That's just being stupid. So yeah, if you're going to go invest all your money in, Dogecoin, then you should expect the consequences of those actions, right? Look, I can be super optimistic, but if I go driving down the freeway at 150 miles an hour, odds are I'm not coming home at some point, right? So
exactly.
So yeah, what we're talking about is we're talking about being optimistic, looking forward, looking for the opportunities. And that's the thing that you'll find with people that are very successful. They're always looking for the next opportunity. They're not looking for the thing to keep them from that opportunity. They're looking for, hey, what's the next opportunity? A good example is let's say some of the stuff that you talk about comes true, right? So we have a recession. There's great opportunities in a recession, right?
Absolutely. That's why I talk about it.
Yeah.
Well, totally. So you're less impacted, but then you're positioned to take advantage of those opportunities.
Right.
Exactly. Yeah.
But see, that's the thing, is like they don't worry about the recession. I've got a really good friend of mine who does real estate, and he's a great investor, and we're dear friends, and we do a lot of business together. But he is like, people are talking about, oh, the commercial real estate space and this and that. And he's like, you know what? There is some awesome opportunities right now in commercial real estate. There are some awesome opportunities, and he's digging right now to find those distressed opportunities where a lot of people are like, I am going to touch that. He's out there looking for those opportunities, and he's going to wind up making a lot of money when the Fed starts cutting rates, because real estate's all about cap rates. And so when the Fed starts cutting rates, those cap rates are going to move, and the profitability in a lot of these properties are going to explode. So it's just a function of, but again, if you're so worried about the recession, you don't go do anything, right? You don't go out and look for real estate investment opportunities. You don't go out and start looking for market opportunities because you're too worried about what's going to happen, instead of looking for, okay, I'm going to position myself right now for what's going on. If this occurs, then I'm going to be prepared for that, and I'm going to have an opportunity to buy stuff really cheap when I get to that point. And that's just a function of building out your profile, however you want it. But again, you're look forward optimistically as to what the opportunities to make more money is, because that's what rich people do.
Yep. Real quick, your story is making me think of a guy who may actually be watching this video, but it's a viewer who has been in touch with me over the years, who he was in the early 70s during big real estate depression. His grandmother bought a property, distressed property, I think like on Central Park West or something like that. And basically 2 generations later, hasn't had to work because of this one decision that grandma made when the market just presented a blood on the streets opportunity that she was smart enough to take, right? All right. Well, so the other thing about my takeaway that I just want to get in here before we end things is these people have been very successful. Yes. What is interesting, they're all about my age, so they're all in their early to mid 50s, and they're all, like I said, world beaters, just type A people. They've been programmed from a very young age to achieve, and they're basically picking their heads up at this point in life and saying, you know what? Yeah, I've been successful. And I don't regret too much, but I'm beginning to really realize that my drive to achieve has perhaps distracted me from being happy, from finding happiness. And they all, to some degree, are saying, going forward, I'm really beginning to prioritize that. And I'm actually willing for the first time in my life to say, I don't think I need to go after that next brass ring. The traditional measurements of achievement maybe maybe I'm realizing they're not that important in life, or as important as I thought, and I'm going to focus more on the things that really matter. And of course, these are the things that we talk about in this channel all the time at these ending things, right? It's relationships, it's purpose, it's health, and And it's funny, like everybody actually, I was surprised at how well everybody uh, had held up physically for 25 years, which is beginning to be a fair amount of time. But on average, they all held up pretty well. But I did see, a lot of people there that I could just tell, they were complaining, I've got a bad back now, my knees are shot, whatever. And I could see you and I are still, pretty big into fitness, Lance, and I could see that these people were kind of beginning to fall out of good physical health because they just hadn't been working on it, and now their ailments were becoming the excuse for why they can't work out, right? And so, anyways, it just reiterated to me the value of our discussions, where really, when all is said, money's great, but it's just a means to an end, and the things that really matter in life are those three things. And that, measured from the people I met there, yeah, a lot of them have just crushed me on the earnings side of things. But I kind of feel like, particularly on purpose, with thoughtful money and what I do here, and with health, I'm ahead of a lot of them, and that actually feels pretty good.
Yeah. And look, success isn't a function of money. That's just how we keep score, right? In a lot of cases, it's like, oh, he's really successful, and because he's got $50 million or whatever it is, but he's absolutely miserable. He's got terrible health. He's got no family, because all his family hates him for whatever reason. His kids don't talk to him anymore. So is he really wealthy? Right. I mean, if you can, nobody, we don't want to, put ourselves in a position where we're struggling to make ends meet every day, right? That's not happiness either. There's an old saying, money can't buy happiness, which is very true, but it buys a whole lot of whatever comes in second. But money's important because it allows us the freedom and the flexibility to be happy by doing the things that we enjoy.
Right.
Spend all of our time just to make ends meet. You're fighting with your spouse. You're stressed out over trying to take care of your kids. That's not happiness, right? And so so money isn't really the source of wealth, and it is a broader complex. You don't need $50 million to be happy and to be wealthy. You can be. I've got clients of mine that they've got $500,000 in the bank, and they're retired, and they do everything they want to do. They live very modest lives, but that's what they want, right? And they are very happy with their life. And I've got other guys that I manage money for. They've got 10, 20, 30, 40, 50 million, and they're absolutely miserable.
Yep.
So, it's just, it's all important to keep a balance. And, what is important, right? Family, friends, relationships, your faith. And, I think people discount faith way too much in the order of being happiness, because again, there's a lot of people like, well, I don't believe in all that stuff. And that's your prerogative. And I'm not saying that you need to or not need to, but the one thing what faith gives you is the ability to be optimistic and to look forward and to believe that there is a pathway in front of you of where you're heading to. And if you don't have, Blaise Pascal was a famous mathematician, and he once made the statement, he says, if my mathematical risk of believing in God is that I get to go live an eternal life in heaven, versus if I don't believe in him and my risk is going to hell for eternal damnation, I'm going to take the risk of believing in God, because mathematically it makes a lot more sense, right?
Yeah, Pascal's wager. Yeah.
Yeah, and so but this and that applies to so many things in life, is that we've got to have faith, family, and friends, and we need to have purpose. And you said, and for you, it's what you do with thoughtful money. For me, it's what I do for my business. I get up every day. I love my business. I love what I do because I get to help people, and and that's my purpose in life. But I don't need, for me, the money doesn't matter. I would do it all for free if I didn't have kids and family to raise, but that's why we get, people say, why do you do so much stuff for free? Because I don't really care. It's like, I would rather give it to you so that you have it and you can make better decisions about your financial health than not.
Yeah. And, going back to Stanford Business School, I remember the day that I was surprised in class where we walked in and Warren Buffett was standing there. And this is one of the reasons why it's so great to go to an institution like that. And, he just said, look, I don't have any notes. I'm just here for the next hour and a half. What do you want to know? And one of the key takeaways from that was him basically saying the same thing as you. And people always say, oh, it's easy when someone knows a lot of money, tells you to, follow your bliss or whatever. But he was just like, yeah, my advice to you guys is right now, just stop managing to the resume. Doesn't matter. Like, just find the thing that you would do, even if you didn't get paid for it, that you just love doing, and then find a way to somehow make enough money doing that, and you'll basically have won.
Yeah, that's right.
All right. Well, look, so a number of you have said, hey, we really appreciate the fact that you money guys, make it real by reminding us that money isn't everything, and these three key things really are what sort of makes true wealth. And I talk about how the people who live to be 100, that this is when they're asked, they say it's these three things that matter. So people have been asking me, hey, will you start bringing on at times some experts to talk about these other key areas? So I've committed to doing that. And actually, we're going to do our first one of that this coming Monday. I interviewed a licensed marriage family therapist about the best practices for dealing with conflict in relationships and essentially building strong, healthy, fulfilling relationships. Full disclosure, she is my wife. She was the easy low-hanging fruit for me to go after. But she is been practicing for, I think, about 15 years or so. She's skilled in multiple disciplines. We just recorded it. I think it was a good discussion. I think folks are going to like it. But if you do, obviously let me know, and we'll start doing similar things around purpose and around health and whatnot. And Lance, I'll give you a chance to chime in on some of these things too, because you have embodied them well in your life and your journey. All right. Well, look, as we wrap things up here, cabinet guy, what's the status of that story? Did you have the talk with him?
Oh yeah, I had a very interesting talk with him, and it's there's issues that he's going through, and then we talked about before. He's kind of this younger, he's of this younger generation, and it's the mental health and all this. I explained to him. I said, look, I get all that, right? I have those issues too, but I can't not go do my job for a week at a time because of this, and or whatever the issues are. And he's like, I know, I'm so sorry. I really apologize. Anyway, he did show up, and I did get the shelves installed in my office. In fact, that's what the electricians are here doing. They're installing the lighting behind the shelves right now. He still owes me a good bit of work. I've still got 2 other pieces of furniture from office that he's refinishing. And then there's an enclosed closet that he's got to build out for other stuff. And so hopefully he says he's going to show up this weekend, maybe Saturday or Sunday, and still work on this some more. So maybe I'll have an update for you next week. But, right now, so far it's just very slow progress, but we're getting there. Like I said,
Okay.
it is slowly coming together, and maybe next week I can give you a tour of something. So,
okay. But it sounds like he's still in the fight, and maybe this is becoming a growth moment for him, where he's learning some hard truths, and hopefully it'll make him a better businessman.
I look, it's this, this kind of goes back to what we're saying earlier about being optimistic moving forward, and all this is, look, this is adversity for him. So he's got to make a choice here fairly soon, which is either he is going to buck up and get over this hurdle and get back to working and performing, or he's going to go out of business. But see, that's the challenge of running a small. When you want to be your own business person, this is what you run into. See, and this is the important thing to understand about the economy and the way it works. You either are the provider of labor, or you are the person that is paying for the labor, right? So if you're a business owner, then I'm basically paying you to come do labor for me, and I'm going to extract a profit off of your labor. So, we get all upset about how much corporations make in profits versus the wages they pay out. That's their job. And as long as you're in the position of where your only ability is to provide labor, then you will always be on that bottom end of the tier, right? Because the only ability you have is just to provide labor, and that labor has a value to it. And you may or may not be able to dictate what the value of that labor is. So if the average wage for what you do is X, you may not be able to come in and say, well, I'm demanding Y for that labor, because I can go hire somebody else to do your job at X labor. So this is why it's important to always put yourself in position to increase your skill set, to make sure that the labor if you are a provider of labor, that you're increasing the capital value of the labor you're providing. But if you want to build wealth, you've got to be the guy that is paying for the labor, because that's where you're going to extract your value ultimately, is on the profitability on the other side of that. So he's in that position to where he's running a business. He is basically, in the place to provide, to pay for that labor, but he's not figured all that out yet. And so he's in the position of being both the labor and the payer for the labor, because he's working by himself, and he's got to get over that hurdle. So he's either going to figure out that it doesn't matter what your mental state is from one day to the next, you got to get up and go do the job because you're the labor, right? And the other side of that is if you can't get up every day and go do the labor, you need to hire it out and then build that model that way. And he's either going to figure that out or he's going to go out of business.
Okay. Two important things that worth taking away from this, one of which we can talk about in a future video. But the quadrant that Robert Kiyosaki uses a lot, where you're basically going to pick what quadrant you're going to be in. Are you going to be an employee, self-employed, business owner, investor, right? Probably be worth walking through that for folks, because that is a choice we all need to make, and we can play different roles in there, but it's a good framework for thinking about, what do I want my prospects to be over time? And am I putting myself in the right quadrants if those are my goals, right? And it seems like this guy's having a real-time lesson in that. But secondly, your point about adversity too. Yeah, at the end of the day, the guy just has to decide, is this what I want to do? And do I want to work hard enough to improve this model? Or do I want to say, screw it and go do something else, right? And as an entrepreneur, this is a super important, it's an essential process to go through. As a young person entering the workforce, there's a lot of hard lessons that you have to learn through the workforce if you want to rise up in the ranks. And if you're a parent and you're trying to guide your young adult through this too, it's an essential process they have to go through. It's meeting adversity head on and figuring out how to get through it to the other side. And really, it's tough for parents because we don't like to see our kids struggle. We want to help. But if we do, we deprive them of the learning process, and we deprive them of the ability, of the chance to develop that ability within themselves that they can then use to carry themselves forward. So it really is something where you really have to shift to if someone in your life's going through that, you have to shift to I'm going to support you 100% on this, but I'm going to let you figure it out. And yes, you're going to have to struggle, and it might not be really enjoyable as you go through it, but you will be a much better person on the other side of this. And I'm going to be here rooting for you all along the way.
There you go. Absolutely.
All right. Well, look, as we wrap up here, folks, if you, first off, if the thing that helps you get through adversity the most in your life is to watch these videos every week and get your weekly dose of Lance Roberts, let them know that by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. If you would like help in navigating the markets we have, not necessarily the markets we want to have, but the markets that we actually do have, particularly as it looks like we're heading into a more volatile environment for the markets over the next couple of months, then consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses. These are the firms that you see here on this channel with me week after week. Perhaps you might even want to talk to Lance and his team there at RIA. To set one of those consultations up, just go to thoughtfulmoney.com, fill out the short form there. Only takes a couple of seconds, and these advisors will be in touch with you right away. And then last, just want to remind folks that we are still offering tickets for our fall conference on Saturday, October 19th, for the lowest early bird discount price. We're not going to be keeping that price for all that much longer. So if you haven't bought yet, I want to make sure you get the chance to go lock that price in. To get it, just go to thoughtfulmoney.com/conference. And two quick things. One, if you haven't heard already, just this week we had Fred Hickey of the High Tech Strategists sign on to the faculty. So he's going to be talking all about his latest outlook on the big tech growth trade, the Magnificent Seven, AI trade. So that's going to be a really important, really fascinating discussion. So if that excites you, if that's the tipping reason to come join, you got it. And then secondly, don't forget that if you are a subscriber, a premium subscriber to our Substack, you also get an additional $50 off whatever the ticket price is when you buy your ticket. All right, Lance, with that, as usual, I'm going to let you have the last word.
Look, be optimistic. Have a great week. We'll see you back here.
All right. Well said. Thanks so much, buddy, for joining me for yet another week. Everybody else, thanks so much for watching.